Can just 3 ETFs realistically earn you enough to quit your 9-to-5 job? I went from being broke and having $19,000 of student loan debt to building a $400,000 portfolio in 8 years. Now it pays me over $93,000 annually in passive income. So in this video, I'll show you the 2 reasons why you should invest in an ETF and reveal the 3 ETFs that could build you stable income and rely less on your paycheck. I'll also include a free early retirement calculator to see when you could start relying on your paycheck altogether based on your spendings, savings, and your current net worth. To start, I'll reveal how ETFs gives you 95% of the results with only 1% of the effort. Now, let's say you're eating some buffalo wings for lunch, but you're not an amateur, so you know you have to get some ranch dressing to go with the wings. Now you have 2 options here. The first option is that you could try and get fancy and spend an hour in your kitchen crafting the perfect homemade ranch. So you pick up fresh ingredients from the grocery store and follow the recipe online to the T. Now, when you finish, you could even experiment with different herbs and seasoning to get it to your liking. And even after all that time and effort, the sauce is just okay, because this is your first time making it from scratch. So was it really worth it? Or you could just do the second option where you could just grab a ranch dressing in a bottle from your fridge in a few seconds. It's still pretty good compared to the other one that you made, but maybe it's not perfect, but it gets the job done well and it saves you all that time and mess. So how is this like ETFs? So just like the first option of making your own sauce, you could spend hours researching individual stocks, diving deep into financials, and trying to predict how the stock market is going to move. And even after all the effort, there's still a chance that you'll end up losing money because even the best financial analysts who are working around the clock still struggle to consistently beat the market. Or instead, you could grab the investing equivalent of a bottle ranch or ETFs. And there are a lot of benefits to them because 1, they're beginner friendly since you could start investing with as little as $5 by buying fractional shares. They're also tax efficient, so you'll pay less in capital gains tax compared to other investments like mutual funds. They're highly liquid, so you could buy and sell them anytime the market is open. And most importantly, ETFs offer diversification. Just buying one share of an ETF, you gain exposures to dozens or sometimes even hundreds of different companies. This means less risk, more stability, and just way less stress, giving you 95% of the results with fraction of the effort. Next, I'll show you why you always win with ETFs. Because did you know that Jeff Bezos and I have an average net worth of $100 billion for each of us? Pretty impressive, right? Okay, so Jeff Bezos is obviously doing all of the heavy lifting here with $200 billion, but this is exactly how averages work. And this is also why average income in the US is much higher than the median income because of people like Jeff Bezos that skew the average towards the higher end with their crazy high incomes. But ETFs also work in a very similar way. So when you invest in an ETF, you buy into a basket of different companies. Some of these companies will barely grow within the year, and many companies might even lose money this year. But a few companies will grow so much that it will pull the entire group's average higher and drive your returns. But the hardest part of picking stocks is that it's really challenging to predict who will be those big winners. Because in some years, it will be giant companies that you've definitely heard of, like Apple, Amazon, and Google. And other times it'll be just much smaller and lesser well-known companies that can emerge out of nowhere and deliver incredible growth and outperform even the biggest names. So that's exactly why ETFs are so powerful, and it almost feels like a cheat code. You don't have to guess which stocks will be this year's superstar. But instead, if you simply own the entire group and hold it over the long term, you'll always win year after year with the fastest growing company for that time period, whoever they might be. Next, I'll reveal the 3 ETFs that can help you out-earn your current paycheck by helping you build steady wealth and move closer to financial freedom. And the first one is what I call the passive income ETF. So if your goal is to eventually live off your investments and generate reliable passive income, you'll love this one. It invests in stable, high-quality US companies known for the consistently paying dividends. Companies like Verizon, Home Depot, and Texas Instruments. And you get a steady growth along with regular cash dividend deposited directly to your account each quarter. So their dividends yield is around 4.03%, and his 1-year return is approximately 4.57%. And the 5-year average return is around 12.73%. And over the last 10 years, it's averaged around 10.47% annually, which is amazing. So let's say you actually take this 10-year average and plug it into our early retirement calculator, minus 2.5% for inflation, which will give us around 8% annual return. And if you're 22 years old with $65,000 salary and $0 to your net worth, and then let's say per month you spend around $2,500 and save around $1,500. That means you'll be able to achieve financial independence in about 24 years by the age of 46, which is almost 20 years before the typical retirement age of 65 when most people retire by. And you'll have 3 times the amount of money that median 65-year-old would have at age 46. And this passive income ETF has an expense ratio of just 0.06%, which is extremely low. Especially as you get closer to quitting your 9 to 5, this ETF will help to replace your paycheck with passive income, giving you financial flexibility and a peace of mind. And this first one is called SCHD, or Schwab US Dividend Equity ETF. Now the second one is what I'll call the set it and forget it ETF. If you want a simple, stress-free investment strategy, this ETF gives you an instant access to the entire US stock market, from small and promising companies all the way up to huge names like Microsoft, Amazon, and Google. Its 1-year return is around 11.26%, and its 5-year average annual return is about 15.3%. And over the last 10 years, it's averaged around 11.62% per year, and this has an incredibly low expense ratio at just 0.03%. So this ETF is ideal if you're looking for a broad diversification, steady long-term growth, and a straightforward investment that you could hold on to forever without worrying about it. So this second one is called VTI, or Vanguard Total Stock Market ETF. Next, the third one is what I call the Growth Engine ETF. So maybe you want to speed things up and grow your wealth more aggressively, but with some more added risk. And this ETF focuses specifically on technologies and innovations, tracking the top 100 non-financial companies listed on the NASDAQ. So that means you're directly investing in fast-growing industry leaders, companies similar to the second one, including Apple, Microsoft, Amazon, and Meta. So its 1-year return is roughly around 12.86%, and its 5-year average annual return is very impressive at 17.5%. And over the last 10 years, its averages around 16.95%, and the expense ratio is slightly higher than the other two at 0.2%, which is still considered really good, but still very reasonable given the growth potential. However, this ETF is more volatile, but with bigger upside potential. Great if you're looking to accelerate your path to financial freedom and grow your wealth faster, even if the lows are lower and the highs are higher. And this third one is called QQQ, or Invesco Nasdaq 100 ETF. And now, even though you now have 3 solid ETFs that could actually help you ditch your 9 to 5, knowing about these ETFs doesn't really help you at all if you don't actually have the money to invest in the first place. So watch this video next where I'll break down exactly how I saved $100,000 on a modest $65,000 salary so you could get there faster than I did.